It's been 6 months since President Trump was elected as a disruptor, specifically disrupting the status quo. And during the past 6 months, one of the markets he's disrupted the most is the gold market, both physically and in price discovery. In this gold market commentary for Friday, May 30th, 2025, we'll take a brief look back at what's happened to the gold market over the last 6 months and try to project forward how this may continue to affect the gold market going forward. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We are a national, physical, precious metals, and vintage U.S. gold and European gold coin dealership. If we can help you with any of your needs in the physical arena, whether you're buying or selling, we'd love to have that opportunity. Since I started American Gold Exchange in 1998, after being in the business for 18 years and learning my trade, I've seen a lot of things happen. Now, back then, we had a balanced budget under President Clinton in 1999 and 2000. And we had indiscriminate central bank gold selling, where they were all dumping on the market at the same time because everything was so good. We also had a peace dividend starting in 1992, following the dissolution of the Soviet Union and the fall of the Iron Curtain, and a computer revolution. All those things culminated in the gold price bottoming at $252 an ounce. And then the central banks of the world decided, hey, we're not just going to dump on each other and reduce our own holdings value. We'll have the Washington Accord, where we will coordinate with each other future central bank selling. And that punched gold back up to $326 an ounce. And gold settled back in around 300, but then we were attacked, 9/11. And we went to war a couple months later in Afghanistan and a year later in Iraq. And both of those wars didn't go quite so easily and as fast as we thought they might. So as they lingered, we spent more and more on the war effort, which was deficit spending. And gold started to climb in earnest, all the way up towards $500 an ounce, moving towards the great financial crisis in 2008. At that point in time, gold had moved over $800 an ounce and got all the way to $1,000 an ounce. When the GFC hit, we saw a liquidation, which pushed gold down briefly for a period of time. And then as the government fought the effects of the biggest economic disaster to hit the country in decades and threw money at the wall through QE1, QE2, and QE3, gold continued to march higher all the way to almost $1,900 an ounce, where it peaked. Now, once the world economies and the U.S. economy stabilized, gold traded for about 6 years between $1,050 and $1,375 an ounce, leading into 2019 and into 2020 when COVID hit. At that point in time, gold was about $1,675 an ounce. We saw a much more pronounced sell-off and recovery, and then gold took off on the back of $6 trillion of new debt to help compensate for economic closures. And gold punched all the way up to $2,070 an ounce, where it channeled between $1,750 and $2,070 for the next 4 years in particular. And we also saw during this period of time a huge explosion of physical demand for gold following the eruption of COVID in March 2020 that lasted all the way to 2023. You see, we trained a lot of people to buy gold following the great financial crisis in 2008 to 2011. And all those people jumped into the gold market in earnest once COVID hit. And our business went from about 80% of normal volume to 400% of normal volume. And it was a huge, physically driven market. But that's not the same market that we're seeing today since President Trump has been elected. This is a gold chart since President Trump was elected. When he was inaugurated in January of 2025, gold was about $2,750 an ounce. And today it's just under $3,300 an ounce for a 20% gain. Now, not really much has changed since President Trump was elected, except for the tariffs. Everything else is pretty much still the same, except for all the turmoil and uncertainty President Trump has created through his imposition of tariffs. And that's what's driven gold higher, 20% higher today. And he's also driven the physical market crazy in the process. Let's take a look. When President Trump was elected and started to talk about tariffs being imposed, we didn't know whether gold or silver would be tariffed. And what happened was the difference in premium between a physical ounce of gold in London, where most of the gold is actually stored, and the corresponding New York Comex market, where most of the physical gold is actually hedged to mitigate price risk, the premium in New York started to increase over fears of tariffs, causing JP Morgan and other big bullion banks to fly gold from London to New York. Here's why. If you buy gold in London and it's $2,750 an ounce, and you want to hedge it to mitigate price volatility, you sell it in New York, usually at about the same price, $2,750 an ounce. And that's what the market was like in November when President Trump was elected. Well, as we got into December and January, and the potential for tariffs being placed on gold and silver started to ratchet up, so did the premium in the New York Comex exchange went higher as well. If gold in London's worth $2,750 and tariffs are going to be applied if you bring it into the US, well, that theoretically makes that gold in the US worth whatever the tariff increase could be, $2,800, $2,850 an ounce. So the premium went up on gold that was hedged. But if you sold it at $2,750 an ounce and you weren't going to deliver that gold and you had to buy those contracts back to roll your hedge forward, which is what most bullion banks do, then you're going to buy that contract back. Even if the price didn't materially change because of the premium, it went up almost $70 an ounce at the most. You're going to lose that $70 an ounce when you roll your hedge to the next most currently traded month when the contract that you sold becomes due for delivery. So typically, if you're hedging gold in December, you're going to sell the next most actively traded month, which is February. That's how the market works. Then you buy February back and you sell April. Then you buy April back and you sell June. That's how the futures market works. Well, if you're rolling that hedge and the premium goes up between the time you sold it and the time you buy it back, even if the price doesn't change, you're going to lose that premium. And that was the trap that the big bullion banks got caught in, hedging physical gold that they owned in London on the Comex exchange in New York. So how do they solve the problem? They brought the gold over and delivered it into the Comex, because when they deliver it against the contract, they're actually recapturing that premium. If you're hedging millions of ounces of gold and the premium goes up $50 to $70, which is what the premium increase was, you're going to lose that premium increase on millions of ounces, which is hundreds of millions of dollars for these big bullion banks. So that was a stop loss move for them to bring gold into the US market. That's all it was to start with. But then the banks realized once they had stopped the losses and delivered against their future sales on the Comex exchange, they could continue the transaction, only this time earn profits on it, as long as the premium in New York was higher than it was in London. And that was the case all the way until Liberation Day, when no new tariffs were announced on gold and silver. And after that, the premium differential between New York, which was higher, and London collapsed back down to normal market conditions. So suddenly that premium has collapsed. And that whole opportunity first to stop losses and then to earn profits on this gold movement evaporated. And that's all this was a price arbitrage. But it caused 25 million ounces of gold to move outside of the US into the US in a very brief period of time. But it caused 25 million ounces of gold to move from outside of the US, primarily London and Switzerland, into the US, which is a huge physical movement of gold capable of being accomplished by only the biggest bullion banks who had the wherewithal and the means and could abide by the regulations, the strict regulations that the Comex exchange applied to anyone trading in the futures markets and delivery at the same time. And if we look at how much gold the Comex warehouses have held in them over time, between 1995 and the great financial crisis, the amount of gold in Comex warehouses rose from about 5 million ounces to just under 12 million ounces. And then once the great financial crisis passed, that eased back down a bit. When COVID hit and we had a huge physical demand for gold in the US because gold was being sold hand over fist to the public by dealers like myself as an insurance policy against future economic uncertainty that COVID brought, well, we got the Comex warehouses up to almost 40 million ounces. And as time passed between 2020 and 2023, we saw those ounces drawn down in a pretty responsible manner. But then when President Trump started to create fears over potential tariffs in New York and the premium increased sharply, so did those imports of gold into the US. And we got all the way to 45 million ounces of gold in Comex warehouses. But there was no corresponding underlying massive physical demand for that gold in the US during this phase, like there was between 2020 and 2023 when COVID hit. And if we look at it from a little bit closer angle, you can see we didn't quite get to the same level for the amount of gold in Comex warehouses. In fact, we got down to just under 17 million, about half the market peaked at. And then we went up almost 30 million ounces. This is a huge movement of physical gold into the US, all because of fear over potential tariffs being enacted on gold or silver. And what happened when Liberation Day came and no tariffs were announced, the premium collapsed. And that gold started to move back out of the US where it would find a better home. Now, some of that has gone back to London, and some of that has gone to Asia, where the premium in Japan and Asia is higher there than it is here now. And this chart shows a little bit more graphic on how the inventory has changed just in the last year or two to the high side, and more importantly, the daily change going in that's now reversed and is now going out because the premium differential between New York and London has evaporated. So this is what fear over potential tariffs on gold caused physical gold movements that have been abnormally large to move into New York and are now moving back out of Comex warehouses, all over fear of tariffs. Now, with regard to the price of gold and tariffs, this is really quite interesting. I've created a 6-month gold chart where I've matched in chronological order the tariffs between the US in red and China in purple as they escalated. I've never shown this chart before till now. So we go through in chronological order. You can see when all of this tariff episode between the US and China started, gold was about $2,850 an ounce when President Trump said, hey, we're going to impose 10% tariffs on China. And up to that point, they were, I think, 2 to 3%. China responded 3 days later with some very strategic export controls. That's when they said that they wouldn't export rare earth metals to the United States, but no corresponding tariff. Then on March 4th, President Trump said, hey, we're going to increase that tariff on China to 20%. On March 10th, China responded by putting tariffs on U.S. farm products, specifically corn and soybeans and pork and beef. This remained the status quo until Liberation Day, when China announced tariffs on all nations. Well, 2 days later, China fought back by saying, hey, they're going to increase tariffs on the U.S. to 34%. And President Tariff said, oh, yes, well, we'll make yours 54%. And over the next week, as the markets absorbed the reciprocal tariff shock that those abnormally high tariffs, the unexpectedly high tariffs caused, President Trump pulled the reciprocal tariffs on every nation but China on April 9th. But we said instead, we're going to increase Chinese tariffs another 50% to 104%. China responded by saying, okay, we'll increase yours as well, 50% to 84%. Then we went to 124% and then 145% on China, while China responded by saying, hey, we're going to put 125% tariffs on the US. And the gold price exploded higher in response, from just under $3,000 an ounce all the way to $3,434 an ounce over the next 2 weeks, driven primarily by Chinese hand over fist buying of gold. Because if you're a Chinese citizen and your biggest customer is the United States, and suddenly they're placing exclusionary tariffs on your goods, and all you have to invest in our stock market and the property market, both of which have been under severe strain since COVID in China, and gold, well, gold is working for you. So they doubled down and bought gold hand over fist and drove the gold price up $500 intraday to a peak of $3,500 intraday. And then President Trump said, hey, we have the potential to ease this situation back down. And the gold price broke down. About a week, 10 days later, we had our negotiations in Switzerland where we said, hey, we will put 30% tariffs on China in exchange for you putting 10% tariffs on the US. And the gold price eased a bit further down to a low of $31.85. And as we've gone forward over the last couple of weeks, we've seen another knee-jerk gold price movement driven by tariffs, this time against the EU, where President Trump just a few days ago said, hey, we're going to increase the tariffs on the EU to 50% because they're not negotiating in good faith. And overnight, gold jumped $60. 2 days later, they said, hey, we're going to go to the negotiating table in a month. So gold fell $60. So this shows you how directly these tariffs, specifically against China, drove the gold price in a chronological fashion from about $2,850 all the way to $3,434, a $500 gain plus over tit for tat tariffs. President Trump and his tariffs drove gold crazy again, this time in the price market, the price discovery market. If you think about it from the Chinese perspective, the U.S. imports about a fifth of everything China exports. So we are by far their single largest customer, taking in 22% of their consumer electronics, 19% of their home appliances that they export, 17% of textiles and clothing, 17% of optical and medical devices, 17% of wood and wood products and paper. That's about a fifth of everything they export to us. And now we're saying, hey, 145% tariff, which is exclusionary. So they freaked out and bought gold like crazy, which is one of the only things they can do in response. And that is what has propelled gold so much higher. If you compare our imports and our exports to China, We export to China about $170 billion of worth of goods a year, while they import to us, or we import from them, about $550 billion worth of goods. So that's about $380 billion trade deficit we have with China on an annual basis. And that's what these reciprocal tariffs are designed to do, to reduce the trade deficit that we have with all these different nations. Only President Trump has been so aggressive in his negotiating tactics that he's driven a lot of markets crazy in the process, including the gold market. What hasn't changed since President Trump was elected are a lot of the fundamentals that he inherited. They remain the same. Our debt is on track to continue to move substantially higher. In fact, the big, beautiful bill could add $4 to $5 trillion debt ceiling increase to the United States, which would push our debt ultimately to over 40 trillion towards 41 trillion. Today, it's about $37 trillion. So our debt hasn't changed at all in the short term. And central bank gold buying continues at a record rate. Central banks were mostly gold sellers between 1950 and 2010. Following the great financial crisis, they became net buyers. And since we weaponized the dollar, they've doubled their gold buying to over 1,000 tons a year for the last 3 years, which is material and is what has helped drive gold from under 2050 in 2024 last year all the way to 2,800 in October of last year. I was one of the first dealers to really drill down and understand, hey, central bank gold buying has become material in the last 3 years, and it's driving the price. Because when gold went over $2,100 and got to $2,200, I was looking for the answer, and I found it in central bank gold buying. And all this de-dollarization talk that was all the rage last year completely missed the point. There won't be a viable currency to challenge the dollar for quite a while. The Chinese government is not going to cede control over their value of the yuan in the same way the Indian government is not going to relinquish control of the value of the rupee to each other or to anyone else. The currency of choice for central banks isn't some currency they're going to invent. It's gold. And I figured that out last year, while most other dealers that have been big proponents of the de-dollarization movement completely missed what was right under their noses. It's been gold all along. And that's not going to change either. Not for the short term, especially with the erratic style of President Trump's negotiating tactics, which are causing some distrust among our global trading partners, friends and foes. So these are the gold price drivers that I identified last year when I tried to figure out what was going on with gold moving over $2,100 an ounce for the first time, which led to our video, Gold's Bullish Perfect Storm, last summer. Gold has been tracking the U.S. debt higher. Check, we're still there. Central banks have become record buyers of gold. Check, even at the highest price ever, they're still buying. Inverse correlation to the dollar and treasury yields. Check. The dollar has been in a pretty big downdraft for the last couple of months, down 10%. It could be in a bear market for quite some time still. That'll help to drive gold. If our economy weakens, which it looks like it is in earnest, let alone from higher tariff cost inputs, putting the margin squeeze on corporations. If we start to lose employment, jobs, the Fed will be forced to ease. And this could be a much sharper easing cycle than most people realize could happen. That's good for gold. Gold continues to be a hedge against economic and geopolitical instability. In January, I did an interview with Talking Wealth, where I said, regarding the Ukrainian-Russian war, that war is going to get settled on Russia's terms because they're dominating the war. And now that we've backed away even further from our support of the Ukraine, Vladimir Putin is doubling down, and you see that in the news lately. So that conflict is going to continue, and probably to Russia's advantage, the way things are going. So we've got that war going on. We've also got the war between Israel and Iran, which has been quieter. Maybe that one will actually get negotiated. Hopefully it won't be negotiated by Israeli warplanes. I really fear that that could be a problem. So let's hope that that's not what happens. And then, of course, gold is a hedge against currency debasement and inflation, which is going to continue to erode the purchasing power of our fiat currencies, especially as our debt continues to grow. And hopefully we won't go through another episode of inflation like we did in 2023 when it spiked to 9%. So I think that the fundamentals that have been driving gold higher remain in place. All of the knee jerks that we've gone through, especially with gold moving substantially higher over tariffs, are starting to ease a bit. Right now, gold is holding pretty well between 31.75 and 33.50. And I would have thought that if gold was going to give up some more of those gains, it would have done so already with this ratcheting down of tariffs and some negotiations really happening. Maybe that'll still happen. But I think there's a big baseline for gold under $3,000 an ounce. Goldman Sachs has recently said they think gold will be $4,000 an ounce before this year is over, and that's my projection as well. Others think higher, but I think that's pretty aggressive. But the fundamentals that have been underpinning this gold market for the last couple of years, not much has changed. And now we have President Trump's disruptive trade policies. And time will tell whether they work out the way that he would like them to. I hope they do. In the meantime, it's going to be pretty interesting. So that's our update. Thank you so much for your time. Thank you for the loyalty and trust that you've placed in us over the last 27 years, and especially to all our clients who have done business with us. Without you, we wouldn't have a business, and we remember that every single day. So that's our update. Thank you, and have a great week.